All right. Good afternoon, y'all. This is Adam Nash, and he's going to be presenting on personal finance for engineers. Adam Nash is the entrepreneur in residence at Greylock Partners, previously hung out at Wealthfront, LinkedIn, eBay, and Apple. So he knows what he's talking about. Is that fair, Adam?
We'll see. We have an hour. Well, listen, I'm glad to be here, and I'm happy to see so many people tuning into this lecture. The truth is, this topic is one that's very important to me. I became interested in personal finance when I was a college student, and I've written about that story quite a bit. But I was always surprised as I went through my career as an engineer and then a manager and then as an executive, how little companies did and schools to prepare students and employees for personal finance decisions. And it turns out to be a very important topic. It's not a particularly difficult topic, but it's one that's just not taught anywhere. And so as I rose up in the ranks at different companies, I started giving informal talks to my employees on the topic. These slides actually turn out to be very closely related to the slides I gave in a talk at LinkedIn in April of 2011, just about a month before the IPO. And since then, I've given this talk at probably over 50 different companies, mostly pre-IPO, but some post-IPO, just to try and help people get a little bit better educated about personal finance. The title is Personal Finance for Engineers. It's completely okay if you're not an engineer. I like to use the title, though, to kind of emphasize the fact that there's an audience here of people who actually do face serious personal finance decisions, who are comfortable with mathematics, and yet for many reasons don't have any formal exposure to topics in personal finance. As Caleb mentioned, I was previously the president and CEO of Wealthfront, and when you work for an SEC-regulated financial provider, you get used to making certain disclosures. So I'm going to make a couple now. You should know that I'm not a financial planner. This presentation is not financial advice. In fact, in general, I would prefer it if I would recommend that you never make serious financial decisions based on any information you see on any video chat online, even if it's from someone like me. The point of this whole presentation is actually to get you thinking and to get you some information so that you can continue your own personal education and make better decisions yourself. I often get asked why personal finance, and as I mentioned earlier, it's a topic I'm quite passionate about. I find it quite striking that of all the subjects that are covered in school, you can go to a fantastic high school, you can go to one of the best universities in the country, you can have an IQ that's 3 sigma above the median, and yet it's not typically covered, right? So this isn't about intelligence, this isn't about quality of education. It turns out that almost no institutions actually offer coursework to prepare you for simple personal financial decisions. It's not a technically difficult topic, but the signal to noise ratio is terrible. You need to understand that worldwide, I mean, even in the US alone, you're dealing with over $34 trillion of liquid net worth. And it turns out that the web is good for a lot of things, but if you put $34 trillion out there, people will publish 1 trillion web pages of basically sales pitches for every financial product out there. So while I'd love you to be able to get educated about this topic just by doing a number of searches and looking yourself, it turns out it's very, very hard to weed out the real information from the sales pitches. And I do believe it's an important topic. I mean, to this day, money is one of the top reasons that relationships break up in the United States, married and unmarried, as it turns out. So this is an incredibly important thing to talk about and to learn about. But it turns out that most Americans don't talk about money. And that's actually a problem because it leaves most people with financial education that reflects what they learned when they were younger, right? You may have had an uncle who was good with money or a freshman roommate who was trading stocks since they were 12. If I look skeptical, these aren't particularly great sources for you to get your financial information from. And so the point of this presentation is to get you introduced to some of the topics. And then I'm hoping you'll follow up this presentation by starting to take some of the great online coursework that is available online from a wide range of institutions and sources now to kind of deepen your understanding of these topics. All right, so I'm going to cover 5 different topics right now in this talk. I know what you're thinking, Justice League, and what's the connection? It used to be a movie poster from Fast and the Furious 5, right? Because I'm covering 5 things, and the Google image search gave me Fast and the Furious 5. Unfortunately, it turns out that because that guy died, it became kind of depressing, so I had to flip it quickly to the Justice League, and I like comic books. And I don't want to hear it from anyone. I know there are more than 5 superheroes in the Justice League, whatever. I just need 5. So we're doing 5 things. One, we're going to talk about behavioral finance. When I was in school as an undergraduate, there wasn't a lot of coursework available on behavioral finance. But 20 years later, there's been a couple Nobel Prizes issued, even this most recent one in 2017 to Thaler. Really has emphasized behavioral finance as an important discipline to understand, especially if you want to understand your own relationship with money. The bulk of this talk is actually about that. After I finish talking about behavioral finance, I'm going to talk about 4 more topics: liquidity, cash flow, compounding, and then I'm going to try and convince you at the end that good investing is boring. And in fact, I'm going to go so far as to say if you get really excited about investing, you're probably doing it wrong. So we'll get to that at the end. All right, so just to start this, I always ask my audience a question. How many of you think that you're rational with money? And so it turns out when I give this talk at most technology companies, about 2/3 of the hands go up. But you knew where this was going, right? Like it's a trick question. You're not rational with money. There's just no chance. And I know what you're thinking. You're thinking, Adam, look, you don't know me. I'm actually a very rational person. I'm very good with math. I'm rational with money. And the truth is, I don't know you. And look, if you are rational with money, congratulations, because you're the first human being out of 7 billion to be so. It turns out that we are not wired to be rational with money. In fact, even if you just go to Wikipedia, you'll find a gorgeous visualization of over 100 different ways that it's been documented that humans make irrational decisions with money. I don't have time to go through 100 different ways that you're rational with money, but because these emotions around money are so important and have been so well documented, I thought I would try to go through in the next 30 minutes 10 of them that are the most common, just to give you a sampling of the ways that emotional decision-making can affect your rationality when it comes to money. So the first one I'm going to talk about is anchoring. Anchoring is actually fairly old in the academic literature. There are empirical studies going back decades that document this behavior. Anchoring is really a simple concept. It turns out that numbers stick in your head, right? And it doesn't have to be a special number. It can be any number. They just seem to stick in our mind. And then when we're forced to estimate an answer, those numbers that stuck in our head affect the answer. So if you were watching The Price is Right and you spin the wheel, tick, 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 3,000, and then someone asks you what the weight of an adult hippo is, 3,000 comes to mind. It just sticks in your head. Now, obviously, it doesn't change your answer to 3,000, but it puts a thumb on the scale, right? So if you asked 100 people a mathematical question they didn't know the answer to, like what the weight of a hippo is, you might see a distribution, right? You know, a high, low, something in the middle, a mean and a median. If you show them a number like 3,000 and then ask 100 people what the weight of a hippo is, the entire distribution shifts. And in fact, it condenses a bit. It's not that the mean and median become 3,000, but the entire distribution shifts towards that number. And it doesn't have to be a relevant number. It's been documented now that people, any number will do. Addresses, social security numbers, phone numbers, numbers just stick in our head and they affect the answers we give. Now, if you think that's a powerful effect when it's a random number, imagine when the number isn't so random, right? So let's say you have a friend, a good buddy, who bought Apple stock at 100, right? Well, you look at the stock market and you see that Apple stock is at 150. Part of your brain thinks that Apple stock is expensive. If Apple stock were at 50, part of your brain thinks that Apple stock is cheap because it's less than 100. Now, look, in all fairness, there's a lot of different theories about how to value equities in the stock market, like Apple, but none of them involve what your friend bought the stock at. Like, the world does not care that your friend bought it at 100. But these numbers stick in our heads, and they're even more emotional when they're numbers that are in our own lives. What if you bought the stock at 100? You start pegging all of your financial decisions based off that. It turns out those are not the right ways to make financial decisions. And those emotions, the fact that these numbers stick in our heads, get in the way of us getting to real mathematical answers. Mental accounting is a very powerful form of bias. I don't know how many of you watch TV or seen the commercials from Voya, but actually they're pretty good commercials to demonstrate the concept of mental accounting. They'll show you a grandfather at the amusement park with their grandson. He's about to get his grandson ice cream, opens up his wallet, and 2 of the bills are orange. And their whole pitch is like, you shouldn't spend the orange money. That's mental accounting, right? The idea is that money doesn't care what it's spent on. A dollar is a dollar. But we put labels on our money, and that affects how we make decisions for it. So if you look in the academic literature, a lot of the examples given in early courses are like the movie tickets example. So let's say you were in the city in Silicon Valley, and you were going to go to the movies with a friend. And of course, being Silicon Valley, a movie ticket's now $20. So you started with $80. In scenario 1, you bought the 2 tickets ahead of time, right? So you get to the movie theater, you open your wallet, and the 2 tickets are missing. You lost them along the way. But you still have $40. Do you go to the movie, right? In this case, some people do, some people don't, but most people really don't like the idea of spending $80 to go to the movies, right? In the second scenario, you didn't buy the tickets in advance, right? So you just go to the theater with $80 in your wallet. You get to the theater, open up your wallet, and 2 of the 20s are missing. You lost them along the way. Do you go to the movies? Well, in this case, most people don't hesitate. I mean, after all, it kind of sucks to lose $40, but why would you let that get in the way of a good time going to the movies, right? The fact that you feel differently about those 2 situations has a lot to do with mental accounting. In both situations, you had $80, wanted to go to the movies, and then lost $40 in value. Why does it feel different? Whether you lost the tickets or you just lost $40 cash. And the answer is because once you bought the tickets, that didn't become generic money. It was movie ticket money. And you don't want to spend $80 going to the movies. That's the power of mental accounting. And it may sound trivial or fun, but it actually turns out to be very counterproductive. I mean, there are too many Americans out there who have several $1,000s worth of credit card debt, but also have a few $1,000s saved up for a summer vacation, right? There is no scenario where that makes financial sense, right? You're probably paying 20, 25, maybe 30% interest on that credit card debt. But you've separated out the summer vacation because that's something that you want to do with your family. And the reality is it would even be better financially, I'm not recommending this, but it'd even be better financially to take the thousands of dollars, pay off the credit card debt, and then next summer put the vacation on your credit cards, because at least you wouldn't be paying interest for the next year. But these separations are very powerful. Once we label money, we obey those labels. If you make a budget and you say you're willing to spend $300 a month on clothing, when you get to the end of the month, if you haven't spent $300 on clothing, people feel like they have to go to the mall and spend it, like maybe get new sunglasses or something. These labels control our behavior. And so you should be very careful with them. I'm actually going to talk later in this presentation about ways you can use mental accounting to your advantage. It's not a bad thing, but it definitely is a very powerful thing. So some of these insights about money actually come from statistics. And so for any of you who have exposure to statistics, you'll like some of these. So confirmation and hindsight bias both come from the world of statistics. They're different, but when combined, they're very, very bad for financial decision making. So confirmation bias is fairly simple, and it's been in the news a lot lately in the last couple of years, particularly around social media. It turns out that we have a bias towards decisions that we've already made, right? If you believe that gold is a good investment, you could read 10 different articles, 9 of which that say that no, gold is a shiny yellow metal, and actually it's not a good investment. And one article that says actually the Fed's printing money and gold's going to go to 5,000. And if you like gold, you have a tendency to look at that last article and go, hey, this guy gets it. Like, I like this one. They know what they're doing. The thing with confirmation bias is that we interrogate data that doesn't conform to our bias towards what we already believe. Since a lot of you are in engineering, a lot of you are writing code, you've been in business, you've probably seen this at companies, right? I mean, I used to be a product manager. What product manager looks at the A/B test? The A/B test comes back the way you expect it. Good, we're a data-driven organization. Everyone pats themselves on the back. The A/B test doesn't come back the way it's expected. All of a sudden, everyone interrogates the data. Wait, did we instrument it properly? Does it work right on mobile browsers? What about the native use case, et cetera, et cetera? It's not that we reject out of hand anything that disagrees with our assumptions. It's that we put our thumb on the scale and we really interrogate and push against conclusions that don't conform to our expectations. Hindsight bias is actually very different. Hindsight bias is about the fact that the human brain feels very, very confident about the ability to predict the past, right? We're really good at it as humans. Maybe not perfect, but we're really good at predicting the past, right? Everyone knows that housing is going to crash in 2008. And everyone knows who's going to win the last election, right? We know these things, of course, because they already happened. But that confidence that comes from understanding the past over-represents itself when we have to make decisions about the future. Because we're so sure of ourselves with 2020 hindsight that housing is going to crash in 2008, we think that we're geniuses in predicting where housing is going to go in 2018. And it just doesn't carry over that way. So the problem is when you mix these two, you end up with someone who's overconfident about their ability to predict the future and biased against any evidence against the contrary. I mean, literally your brain, at a neurological level, the parts of your brain that make decisions tend to fire before the parts of your brain have a chance to access data. And being smart doesn't help you here. The smarter you are, the more likely it is that you can rationalize any decision that you want to make. So when you look at confirmation and hindsight bias together, you realize it's a really, really powerful cocktail that works against your ability to make rational financial decisions. I don't know how many of you like to go to Vegas or gamble, but fundamentally the gambler's fallacy is one of the more powerful things that works against our ability to understand the statistics around money. It turns out the human brain really is very talented at seeing patterns. Actually, any of you who have studied vision or artificial intelligence know that one of the problems that we're still working on is to get computers as good as humans at not just identifying objects and understanding them, but predicting what's going to happen to them. This is a very complex area, although we're making a lot of progress in it. Humans don't have a lot of problems with it. We're happy to make estimations based on incomplete data. I mean, math might say that you need 2 points to make a line. Humans don't need 2 points. We don't even 1 point will draw a line. Hell, give me 0 points. People, blank sheet paper. Humans will draw lines all day long, right? We see patterns in everything. We see faces, we see letters, we see numbers, we see all sorts of things. We see shapes in the clouds. And that sounds romantic, but it turns out when you're looking at random numbers or random chains of events, it's actually a very bad habit to have. So like if you take Las Vegas as an example, you'll see people do this. They'll walk into Las Vegas, they'll stand there for 60 seconds in front of the roulette table, see it spin a few times, and they'll say things like, I think green's coming up a lot today. No, you didn't just figure out that green's coming a lot today by watching a roulette wheel for 60 seconds. But your brain wants to believe it can find a pattern in anything. You want to find a pattern in the weather. You want to be able to find a pattern in the stock market. You want to find a pattern with everything. And it turns out that actually a lot of financial events actually have to do with random events that aren't predictable. And your brain fights that. It wants to believe that it can crack the case, that it can solve the equation, when in many cases it's actually statistical. This may make sense. It turns out in a lot of human behavior, things aren't truly independent. There may be a reason why humans are wired to believe that they can find patterns. Developmentally, it's actually very good that babies don't look for proof that face looking down on them is their mother. It's actually probably a very good thing that they bias towards safety, but it's not good with your money, and it's not good with the stock market. The math isn't that easy to intuit. Your gut is working against you in these situations. I wrote a post in TechCrunch a few years ago about herd behavior and how it can explain a lot of the activity you see in financial bubbles. It turns out that we have a part of our brain that wires us to understand or want to understand what the animals around us are doing. In fact, there are certain ailments that you can have or issues you can have socially if you don't have that part of your brain functioning well. You've probably felt this before. I don't know how many of you have ever walked into an empty supermarket, but it's actually a very disconcerting experience, right? You walk into a supermarket normally, there's half a dozen people around. You just walk in and start to navigate. But unfortunately, you walk into an empty supermarket and all of a sudden you pause for a second. It's like you don't know where to go. And that's because your brain subconsciously is missing that information about what all the other animals are doing. Speakers see this all the time. When I give my talk to hundreds of people, you naturally see this effect. When one person starts to tilt their head, other people start to tilt their head. They cross their legs, other people cross their legs. We mimic each other as a sign of that social awareness. In fact, if you want to get someone to like you, mimicking them actually turns out to be a pretty good way to do it. Must be a good person. They're doing the same things I'm doing. It turns out that when we buck the crowd, when we don't do what the other animals are doing, it causes stress. And it's not something you get good at. Stress is not something that you get stronger at. It actually fatigues you, right? It turns out that resisting or causing stress is something that leads you to need to relax later. And usually we relax by doing what the other animals are doing. So this is a real problem in Silicon Valley, of course, and with startups and technology, because we all think we're contrarians, right? We're all contrarians together. And so we all think that we're doing something different. But the reality is that that's actually very stressful. Now, in software, doing something different might make sense because the truth is software moves so quickly with Moore's law and Metcalfe's law that the solution for a problem now might be very different than the solution 10 years ago. That is not true with most things in our life. And you'll actually see people who are contrarians 1 in 10 times, 2 in 10 times, do things like when they're driving on the road, they'll just float along with traffic because sometimes it feels good not to buck the crowd. We've all heard the adages about it's easier to be wrong with everyone than right and alone. Back in the day, they used to say no one gets fired for buying IBM. These are all elements of the fact that we like to move with the herd. So when you're looking at major financial decisions like buying a house or buying a stock or investing in anything, you have to ask yourself the hard question. Are you really interested in that? Or is it just because all of your friends are talking about it and you're worried about being left out or missing something that everyone else thinks is obvious? Overconfidence is very well documented. And every time I give this talk, I always have someone who comes up to me afterward and says, Adam, I liked your talk, but I don't believe I'm irrational with money. And inevitably, my answer to them is always the same. It's like, don't worry, that's okay. Overconfidence is highly correlated with IQ. It turns out a well-documented foible of humans is that we overestimate our abilities. 74% of investment managers believe that they deliver above average returns, right? It's the Lake Wobegon problem. Everyone thinks their kid is above average. They think they're an above average driver. In fact, we're so socially wired this way. If someone came up to you and said that they think they're below average, you try to reassure them, say, no, don't think that. You're really above average. You're great. When obviously everyone can't be above average. And it turns out, unfortunately, this is another area where high IQ is not your friend. The smarter you are, the more there is a positive correlation with overconfidence. Now, I know what you're thinking. The smarter you are, well, of course you're confident in your abilities. You're smart. There's two problems with this. One is, remember, the issue is not confidence. Confidence is grounded in data. Overconfidence means that you are overconfident in your ability. You may get the answer right 95% of the time, but in your brain, you think it's 99%. The second problem with overconfidence is it crosses boundaries between disciplines. I mean, you might actually be one of the most talented storage engineers in the entire world. You might be in the 0.01% of storage system architects and work at a fantastic company doing stuff that most humans can't even begin to understand. But just because you are an expert in storage systems doesn't mean you're expert in other areas. But the confidence you have in your day job, the confidence you have in your area of expertise crosses over into confidence in areas where it doesn't belong. Right? So my parents are doctors. Doctors see this all the time. You might be brilliant at what you do during the day, but you get sick. You spend 15 minutes online with WebMD, and all of a sudden you want to argue with the doctor who spent 20 years looking at thousands of cases trying to understand your ailment. It's not a bad thing to do research, but people get overconfident about their ability to crack the case in disciplines where they haven't spent that much time. This obviously makes a difference with money, because for most of us, we haven't spent a lot of time trying to understand money. And as a result, we end up overconfident in our ability to navigate those situations ourselves. All right, I'm almost done with the behavioral finance, but it's really important to understand how we make decisions before we go through the advice of how to make these financial decisions. All right, so recency and availability bias are also from statistics. We overreact to recent events, right? If there's a gun shooting, we talk about guns. If a movie star has a particular disease, we talk about that disease. If there's a plane crash, we talk about plane crashes. Our brain enjoys talking about recent events. It turns out pulling data from yesterday is very easy to do, and we like to do it. And as a result, we have an oversupply of information about things that happened recently, right? If you go online, you'll see 1,000 articles about what happened in the financial markets yesterday, and very, very few articles about what happened 10, 20, or 30 years ago. This by itself would be a problem, but when combined with availability bias, it becomes a serious issue. Availability bias has to do with the fact that we want to believe that our data sets are fair. We want to believe that if we see 1,000 articles about a topic, that there was some reason why the 1,000 articles were distributed the way they were. So if there's some financial event and 60% of the articles are positive and 40% are negative, there's a part of our brain that wants to assume that that's a fair distribution, 60-40. And as you all know, we definitely don't have any magical person actually curating our data sets. And with social media and self-curation, we're doing even more bias around what data we see and what data we don't see. So when you combine these two together, recency bias means we see a lot more information about recent events. And then the availability bias says we think that that's fair. We assume that the recent events must be more important because we see them more often. And of course, the truth might be the opposite, right? In some situations, what happened recently is very, very important. But with a lot of financial decisions, it may turn out that what happened over long historical periods, 10, 20, 30 years ago, is more important for making a financial decision than what the Federal Reserve Chairman said 2 days ago. But that's not the way we feel. It's harder for us in high tech because we're used to information being different, right? There are game changers all the time. You have to keep up with technology. What you learned 10 years ago might not be as relevant as what's relevant today on today's platforms. That may be true with technology. That's rarely true with money. And so our bias actually works against us even worse when you work in an industry like technology. All right, for this last one, I'm going to talk through a little bit of a game. So it's very easy. I'm going to put you in a situation hypothetically. There's no right answer. I'm just looking for you to do a little introspection and see how you feel about these questions, okay? So the first question is, I want you all to imagine that I give you $1,000, and you have to pick one of the two choices. A, I'll flip a coin, and if you win, if you get heads, I will give you another $1,000. You'll end up with $2,000. But if you lose and get tails, I won't give you anything, but you'll still keep the $1,000 that I gave you in the beginning. Or you can pick B and say, Adam, forget the coin. Just give me another $500. I want you to think honestly about which of these you would pick. Okay? Now, in the second game, I want you to pretend that I give you $2,000 to start with. Okay, so all of you have $2,000. And you can say, A, I'll flip a coin, and if you get heads, you get to keep the $2,000. But if it's tails, you have to give me back $1,000. Or you can pick B, where you forget the coin, and you just give me back $500, no matter what. Which one would you choose? Now, if you're like most people, you felt a lot of emotional friction between these two choices. And in fact, many people will switch their choice from A to B or B to A between those two questions. Even if you didn't switch your answer, though, you probably realized that the questions felt different. That feeling you felt is called loss aversion. And in academic literature, it's known as prospect theory. And loss aversion is one of the most powerful emotional biases that we have when it comes to money. Human beings hate losing money. We hate losses more than we like winning. We hate losing so much that most empirical studies show that we hate it 3 times more than we like making money. And that means literally that the pain of losing $1, you have to make $3 to make up for that pain. This has been studied empirically across different countries, different ages, different demographics. It looks to be a fairly universal human trait. And I know what you're thinking. You're saying, Adam, listen, I get it. Look, it's an evolutionary thing, right? You know, millions of years ago, like our ancestors, there are probably people like losing and people liked winning. The people who like losing lost. The people like winning won. And so we're all the children of winners. That's why we all like winning. And look, maybe some of that's true. I have no idea. The point is that math doesn't work really well when -1 and +1 don't equal 0. And that's what loss aversion does, right? When you hate losing dollars, the minute you have something, you're afraid to lose it. It affects almost everything. In fact, if you look at almost every advertisement out there, you'll notice that they're framed around loss aversion. Even simple radio gimmicks where they're like, call now because this deal's going away in an hour. That's loss aversion, right? Every sale has a form of loss aversion. And that's because we learned a long time ago as salespeople and in advertising and marketing that loss aversion works, that it's very powerful. The problem with loss aversion is that any decision can be reframed around losing the other choice. If you have to pick A or B, I can talk to you about the losses if you pick A, or I can talk to you about the losses if you pick B. And I can switch your decision back and forth between them. That's not a rational place to be. In fact, you can do this trick to yourself. Any financial decision you have to make, or a job decision, or even a personal decision, you can see if you're getting emotional about the topic by reversing your discussion of loss and seeing if it affects your feelings about that decision. Anyway, the reason I talk about this so much, and the reason I spent the bulk of this talk on behavioral finance, is not to convince you to be rational. It's to tell you that I think it's okay to not be rational. The key, I believe, is that humans are predictably irrational, to borrow the phrase that Dan Ariely made famous over a decade ago. You should know your own flaws, and the good news is you're not alone. There are millions and millions of other humans just like you who also are trying to make better financial decisions and have come up with systems to do so. So rather than try and become a Vulcan, become a robot, become some perfectly rational financial actor, I would recommend as a path to success to actually understand when you're getting emotional about money and find systems that will help you deal with financial decisions. Okay, so that's enough about behavioral finance. I promised I would talk about 4 more things, and these are all the pragmatic things to get started with your own personal financial life. So the second topic I'm going to cover is liquidity. Now, liquidity is a topic I bring up because in Silicon Valley, people talk about liquidity all the time. They talk about IPOs and M&A and people getting liquid. That's not really what liquidity means. I don't know how many of you like movies, but if you've seen the movie Rounders with Matt Damon in it, it's actually a pretty good movie. Matt Damon plays a character in that movie where for a number of reasons, he has to come up with $10,000 for the mob by midnight. And when you watch the movie, you realize that, wait, how would I come into $10,000 by midnight? ATM is not going to give it to me. Doesn't matter what any bank or brokerage statement says. Even if I ask someone with the money, how do they get the money? Right? That's liquidity. How fast can you get access to cash, to financial value? And it's a very different concept than we're used to with risk. And one of the big mistakes that a lot of young people make is they don't value liquidity high enough. They keep chasing investment return, but they don't understand when they're giving up liquidity. It turns out in life, there are certain situations where liquidity really matters. And when it does matter, if you find yourself illiquid, it can be a terrible situation, which is why I think it's important for everyone to think about their own liquidity. So the reason people find liquidity confusing is because similar to other forms of risk, liquidity is giving up something. And so you should want something in return. If you lock up your money for a period of time, you would expect someone to compensate you for not having access to your money. So the way I explain this to people is like a bank certificate of deposit, right? You can take your money and give it to the bank, get a certificate of deposit for 5 years. Now, you won't have access to your money for 5 years, but it's very safe, right? The scenarios where the US banking system are not giving your money back are really extremely unlikely. So it's safe, but it's not liquid, right? Tesla stock is very liquid, right? 5 days a week. You can buy or sell it all day long. You just don't know what price it's going to be at. Could be high one day, could be low another. It's volatile. It goes up and down. Volatility is another form of risk because you don't know if you're going to get your money back in any given day. And so that's another reason you should demand increased return. So Tesla stock is liquid, but not very safe. It's very volatile. A 5-year CD is very safe, but not very liquid. But in both cases, you want to demand a higher return because you're giving something up. And so the common mistake that people make is they mistake safety for liquidity, right? Liquidity is something else. It's, do you have access to money when you need it? And according to the Federal Reserve, 47% of Americans don't even have $400 liquid if they had an emergency, right? Your car breaks down, something you need money to pay for. Being able to deal with those emergencies without damaging your long-term financial plans is a really important problem. This is one of the reasons that I recommend that most people focus on an emergency fund as one of their first financial goals, right? So it turns out that right now the economy is fairly hot, which means getting a job right now is easier than it has been in previous years. But on average, most Americans, if they lose their job, take 3 to 6 months to find another job that pays as much as their last job. 3 to 6 months is a long time. And so an emergency fund typically has to be enough cash, liquid, to help you cover expenses for 3 months. Now, note that I'm talking about expenses, not your income. If you live a more frugal lifestyle, well, good for you. It's actually easier to cover your expenses. And it's one of the reasons that keeping your expenses low actually can be very helpful if you come into some form of financial distress. The real reason it's important, however, to have an emergency fund is because of your long-term financial goals and the different ways that you treat money for the short-term and long-term. So for most people, I describe emergency funds as insurance, right? So if you put money in an account for an emergency and you end up not needing it, well, that's good. It's like insurance. You didn't need the insurance, right? I have life insurance. It turns out I haven't cashed in my life insurance for the last 15 years. That's a good thing, by the way. It means I'm not dead. By the way, if you're looking for marketing tips, rebranding death insurance as life insurance is probably the best marketing that's ever been done because it's really insurance against you dying. I see a lot of people who balk at the idea of creating an emergency fund because they can't stomach the idea of saving that much cash and not having that cash earn a return for them. That's not the point of an emergency fund. The point of an emergency fund is that if you have some emergency that requires money, like a healthcare emergency, like losing your job, even something as simple as an expensive repair on a car, you need to have enough liquidity so that you can pay for those expenses without damaging your long-term financial goals. Because the way you invest money for the long term doesn't make sense if you have to pull money in and out. It actually doesn't work. It'll be financially negative. So for software engineers, I usually argue to think of an emergency fund like a buffer, right? You have something that you don't want to disturb, like your savings for your retirement, savings for your kids' college, savings for a house, things that are long-term goals that are going to take many, many years. And you do not want a short-term emergency getting in the way of those long-term goals. And the emergency fund is a cash buffer that allows you to absorb the shocks of life without endangering those long-term goals. And studies have shown that people who have emergency funds weather the uncertainties of life better financially and don't damage their long-term financial goals as much. The third topic I'm going to cover, of course, is cash flow. Now, this means a lot of different things to different people, and there's even been popular books 20 years old that talk about cash flow. When I talk about cash flow here, I'm actually talking about a really simple concept, and it's the idea of spending less than you make. There was even a great Saturday Night Live sketch with Steve Martin a while ago. I posted on my blog where they talk about the financial system to ensure your security. And how does it work? It's like spend less than you make. What do? Take what you make and then spend less than that. It's really not more complicated than that. I'm not talking about how much money you spend today or this week, but on an ongoing basis, long term, if you don't spend less than you make, your ability to accrue the capital to then invest and make the returns necessary to meet your financial goals is incredibly constrained and incredibly risky. If you want to see what's in common with most people who are successful financially in terms of reaching long-term financial goals, they consistently find a way to spend less than they make. Now, of course, you can move both ends of that, right? You can spend less or you can make more, which is why investing in your career sometimes can be the right way to make the numbers work. But for many people at certain points in their career, it's hard to move their income aggressively, but expenses are something that all of us could take a second look at. And it's been shown that making a budget, even if you don't stick to the budget, is a highly effective way to have individuals and couples spend less. Just by making a list of everything you spent money on last year and looking at it has the effect of having you take financial decisions more seriously and spending less money in the future. So when I give this talk, I normally get a question saying, okay, Adam, I get it. I should spend less than I make. But what's the right number for the savings rate? Well, it turns out if you go online, you'll find a couple answers that are very common. I'm going to give you those two answers, and then I'm going to give you the correct answer. So the first answer that you'll see online is 10%. You should save 10% of your money. Now, unfortunately, despite years of looking, I have never found any financial justification for the 10% number. The real reason I think that you see 10% out there, and the reason that agents get paid 10% commissions and tithing is 10%, is that, oh, look, humans have 10 fingers. Really, there's no math justifying 10% other than the fact that humans like the number 10. So if it works for you, that's great. It's better than nothing. I guess, yeah, I mean, I figure the United States would be better off if we all had 12 fingers. Savings rates would be better. And I feel bad for Mickey Mouse because I'm worried he's only saving, 8%. But fundamentally, there's no math justifying 10%. 15% is another number that you see commonly. This one actually has some justification. The predecessor to the National Labor Board back in the 50s did some work with unions on pay plans and compensation and put out education that said, if you work between the ages of 25 and 65 and you get a 4% raise every year and you save 15% of your money and you earn 8% above inflation and you retire at 65, you should be able to have a retirement of 20 years living off with 80% of your pre-retirement income. Now, if that sounded like an amazing combination of ifs, it is, right? I spent over 4 years at LinkedIn, looked at petabytes of career data. No one's career looks like this anymore. Income is getting increasingly volatile for people throughout their lives. But that's where 15% comes from. Now, I promised you the right answer. And the truth is the right answer is more is better, right? Every number for your savings rate is better if it's bigger than the other number. 1% is better than 0. 5% is better than 4. 15 is obviously better than 10. 20% is even better. The reason that savings rates are so important is because when you increase your savings rate, you're working both sides of the equation, right? When you save 15% of your money, you're actually teaching yourself to live on 85% of your money. So you literally just lowered your expectation. You lowered your goal. And on the other side, you gave yourself more money to hit that goal. So the greatest thing you can do for your financial future is to get saving immediately, whatever the rate is, and work on increasing that rate over time. Now, there are a lot of common tricks that people use to do this. Some people say, well, they start saving 5% of their money, but they get a 3% cost of living adjustment, and they just practice not spending that adjustment, that increase. If you get a bonus, you get a 10% bonus. Just not spending the bonus means your savings rate is 10%. And unfortunately, the average American actually spends their bonus 3 times before they actually receive it, which is a disastrous pattern. But if you can avoid those patterns and save money over time, you'll be in a much, much better situation to actually reach those financial goals. The one thing I see people also make a mistake, particularly the young people I talk to, is they think that when they're older, they'll have more money and it'll be easier to save. And I have bad news. As I usually tell them, I come from the future. It never gets easier to save. Life has a way of just increasing expenses, commitments, dependencies over time. Expenses tend to go up, not down over time. We get used to nicer things. And even if we don't get used to nicer things, we make commitments to loved ones that are more expensive than ones in the past. There's never a better time to start saving than the present. And the longer you save, the better your financial results usually are. And that's because of the fourth topic I'm going to talk about, which is compounding. Now, most of you know about compounding. There's even like an Albert Einstein quote floating around that it's the most powerful force in the universe. I'm fairly sure he did not say that. And I always think that people in the finance industry like to pretend that famous scientists care about what they do. Isaac Newton did, but I'm not sure Albert Einstein did. But in any case, whether they cared about it or not, you should care about compounding because this is the magic that actually lets people hit most of their long-term financial goals. Now, for most engineers, you're familiar with compounding by another phrase, which is an exponential equation, right? Exponential cost is very, very bad. If you work server side, exponential cost is the thing that makes your servers go nonlinear, and then the site is down. If you want to know why LinkedIn went down on Mondays back in 2007 and 2008, it had a lot to do with the servers going nonlinear and exponential cost. So exponential cost is bad with your software. Exponential returns are very good for your money, right? The problem with money, of course, is that the exponents are over a fairly long cycle, and the base is fairly small. So unlike your software going nonlinear in a matter of seconds, with money, it takes decades for you to see the obvious exponential effects. But the most important thing to understand about compounding is that it's not a linear function. It actually grows exponentially over time. And if you give it time to grow, the results can be phenomenal. So my grandmother, who used to teach science in junior high and math, used to teach me the rule of 72. There's actually a Wikipedia page for it, so it's legit. Mathematically, it's an approximation. It's not a formal law, but it's a very, very easy rule of thumb that can make it easy for you to estimate the returns of something. So you divide any percentage return into 72, and you'll roughly get the number of years it takes money to double, right? So if there's an investment that returns 8%, 8 into 72 is 9. It should take 9 years to double. If you make 12%, 12 into 72 is 6. It takes 6 years to double. By the way, this works with debt too, right? If you have a loan that costs 6% interest, if you carry that loan for 12 years, it turns out that you'll end up paying back twice of what you borrowed, right? So it works both ways. The reason this is so useful is it gets you into the idea of understanding why compounding is so powerful. So 8% may not sound like a high return. Actually, it is in the financial markets, a very high return. But 8% into 72 means you double your money every 9 years. And you might be saying, Adam, what's the point of doubling your money in 9 years? I can earn money faster than that. Well, the answer is, so you double your money in 9 years. Well, what happens in 18 years? A double and then a double isn't 3 times your money. It's 4. What happens in 27 years? 8 times your money. What happens in 36 years? 16 times your money. You extend it out to 45 years, you're talking about 32 times your money. And I think almost anyone can realize that getting 32 times your money is a phenomenal, phenomenal return. And so the problem is that this only works over very long time frames. Now, young people have more time than older people, but most of us have decades and decades ahead of us. And in fact, people are living even longer. And those decades can work for you if you let them. So the point of doing these numbers is just to give you that idea. 4% over 20 years is a little over 2 times your money. 8% over 20 years is more than double 4%. It's not a linear equation. And so the more you earn in return and the longer time period you give it to compound can have very powerful results. I've done some math here. It's a sample return of 8%. It doesn't really matter if it's 4%, 6%, 8%. Obviously, the bigger the percentages, the bigger the returns. But the point is, the longer you give money to compound, the better. And in fact, if you were to save the same amount of money every month from now until the end of your career, it turns out the money you save in the next 10 years, thanks to compounding, would actually end up being worth more than all the money you would save afterward, even if you save for an additional 30 years. That's how powerful compounding is. And it's the reason why the best time to get saving is today. I mean, technically, if you could start saving yesterday, that'd be better. But if any of you invent a time machine, definitely ping me because we can make more money that way. I always have to give a little bit of a point here about debt. Debt is extremely dangerous. It's better that you don't have to be phobic about debt, but compounding works the other way, and interest rates on debt tend to be higher than interest rates on investments. In fact, risk adjusted, the math suggests that an equal investment and debt, the debt will charge a higher rate than an investment return risk adjusted. And so there's no trick you can do where you can borrow money cheaply and then make more money. To do that, you're always taking additional risk. And this is how people get into trouble, right? Because the debt compounds, they can't pay it back. And the way you go bankrupt turns out to be as simple as having debt that you can't pay. Now, some of these interest rates on debt can be very high. In general, you want to be worried about it. You want to be very worried about it. It's indefinite, right? Borrowing money at a high rate for a short period of time is a problem and expensive. Borrowing debt for a long period of time, compounding it, is a real significant issue. And so you want to avoid those long patterns. Now, mortgages are a little bit different because we have tax incentives that actually make mortgage interest cheaper than it should be. Student loans are a little bit different because ideally you're funding increased income for the rest of your career. But for the most part, outside of those two forms of debt, it's good to be very, very skeptical and wary of debt. Not phobic. There are reasons to take debt sometimes, and they can be very good reasons. But it's not a bad pattern for you to be worried about what that compounding will do if it's working against you instead of for you. Now, I promised you that the last topic I would cover is investing. And I'm going to try and convince you here that good investing is boring. Look, we all know from the behavioral finance piece that no one wants to be average. But it turns out that with investing, average is not average. It turns out the average professional investor, not you or me, but the professional investors who manage money for a living, the average professional investor underperforms the market net of fees by something like 50 to 100 basis points. That's about 0.5% or more. And that's what the professionals are doing, right? The average retail investor, which is you or me, the people around the room, the people that you know, actually underperform the market more like 4 to 4.5%. Now, that may not sound like a big number, right? When you're tipping, you probably don't think that much about 4 or 4.5%. But if the entire market investment return is going to give you 7 or 8%, losing more than half of it to basically underperformance can really put a phenomenal dent in your retirement and may even make it so you can't reach your financial goals. The end result is you will beat a vast majority of your friends, your colleagues, your family members, and professionals if all you do with your money is keep your expenses low, invest in a diversified portfolio of index funds, and then keep it balanced over time. Research shows that asset allocation explains 90% of the variance between fund performance. So I use a lot of words here, and you may not know what they all mean. An index fund literally just means instead of picking individual stocks or individual bonds, you buy a little bit of everything. And it turns out it's very, very cheap to own a little bit of everything. So if Apple does well and Google does poorly, or Google does well and Apple does poorly, doesn't really matter. You always own a little bit of the winner. You also own a little bit of the losers. But it turns out for the last 100 to 200 years, the winners over time have more than paid for the losers. Asset allocation is another fancy term that confuses people. Assets are just a fancy way of describing things that you can invest in. And it turns out there's not a lot of new ways to invest that have a lot of credibility. I mean, stocks may sound like a technical word, but a stock is just a fancy word for owning a piece of a business. And people have been building businesses for hundreds of years. A bond is just a loan, and people have been lending money for thousands of years, right? Commodities is a fancy term for stuff. Whether it's corn or gold, people have been trading in stuff for a long time. I can buy it here cheap and sell it here for more money. And then, of course, real estate. We can go back to cavemen. I'm sure someone at some point was thinking that, hey, I'm going to get this cave now. It's a great location. It's going to be worth more in the future. That's all real estate is. The point of this is not to trivialize it. The point of it is to not be scared of it. The best approach is to own a little bit of everything. And the biggest decision you make is how much of each to own. The good news is that it turns out that there are a huge number of very smart people, PhDs and the like, who've studied this problem. And there are well-accepted ways of figuring out, based on your financial situation and how much risk you want to take, how much of each one of these investments you should do. Because the data sets on them are very long. We know how real estate behaves for hundreds of years. We know how stocks behave for hundreds of years, bonds, commodities, etc. And so using that math, you can put these different investments together in ways to balance out the risk you take with the return that you want to have. So my old company, Wealthfront, of course, offers a free calculator you can use with all the funds. You can use it for free. There are at least 100 others online from credible institutions you can use. The point is not so much which calculator to use. They're similar in a bunch of different ways. The point is to pick an allocation that works for your risk level, pick the least expensive index funds in each of those categories, and then make sure it stays balanced through the ups and downs. Rebalancing is really easy. I wrote a blog post about it years ago. You can have a computer do it for you. Sites like Wealthfront and others, automated advisors, actually do this rebalancing for you in software on a daily basis. You don't have to use them. You can also do it yourself. If you just do nothing but rebalance your portfolio every year, you'll probably get at least half the benefit. But the point is that things move differently. So if you have one year like last year where stocks do really well and bonds not so well, every year you rebalance. So you're back where you're supposed to be. That's it. You sell a little bit of your winners, you buy some of the losers, and it turns out which assets perform best in any given year change all the time, right? You don't know what's going to do well this year or next year. And by the way, no one else does either. And if you own a little bit of everything and keep it balanced, you end up on the right side of history, because on average, well, at least for the last couple hundred years, things on average have gone up more often than not. And that's how you end up reaching those great compounding rates to reach those financial goals in the future. So anyway, you've all been very patient. I've included a book list here. I won't go through them all in detail, but a lot of these books aren't just about investing. They're about business. I mean, the essays of Warren Buffett are not really about investing. They're really about understanding how businesses generate value. And he's an incredibly clear thinker and articulate writer. And he's been writing an essay to shareholders of his firm for decades. They're all available online. There are books like Against the Gods, which is about the history of statistics. Even books like, A Random Walk Down Wall Street is the classic, over 40 years of data. It's in its 11th edition. Burt Malkiel was the first to figure out that owning a little bit of everything actually beat not just other investors, but most professional investors as well. That was 3 years before Vanguard came out with the first index fund. Anyway, I hope you find some of these books useful, and I'm happy to take questions.
All right. So the way we're going to do these questions is I'm going to read them out to you, and then I will have you answer them in the order we received them. So let me know when you're ready.
Definitely ready.
All right. What are your criteria then for making decisions on your personal financial decisions?
Well, I think it depends on which financial decisions you're talking about. So it's a pretty broad question. Dealing with your emotional bias, there's no foolproof way to do it. But there are some techniques you can use to make your decisions more informed decisions. It turns out that we make the most mistakes emotionally when we're in our own head, right? We don't talk to other people. We don't actually do it objectively. We just feel a certain way. And so anything you can do to get out of that lock probably will help you make better financial decisions. So for example, talking to another person, when you have to explain your thinking to another person, you immediately force yourself out of that gut feeling mode, and you actually have to rationalize what you're doing. For a lot of people, they make mistakes in math, not because they aren't good at math, but because their emotions get away in their head around money. Actually doing the math and writing it out, or doing a spreadsheet, or writing code, whatever helps you do the equations objectively, can help you actually plan out scenarios. And a lot of the work that firms do in software or financial advisors do in person has to do with doing those exercises and actually showing people the results. There's a part of us that wants to do money by gut feel because we're uncomfortable talking about it. But one of the reasons I do this class is because I believe we'd all be better off if we talked about it more. If there's specific questions about specific financial decisions, I'm happy to go into those. But at a high level, that's how I recommend people actually pursue significant financial decisions. Talk to someone else, do the math, try to make lists of pros and cons, do anything you can to get out of your own head on the decision.
All right. Thank you. So how do you feel about, and I quote, robo investors like Schwab's Intelligent Portfolio?
So I'm massively biased. So, I mean, you're asking the guy who ran Wealthfront for the last 4 years.
No.
So first of all, of course, I don't like the term robo-advisor. I ran the company for 4 years. No robots in the whole building, not a single one. All humans, just writing code and doing financial analysis. But to avoid being silly, I think they're fantastic. I mean, I think over the next 10 to 20 years, we are going to see more and more things that humans used to do poorly be replaced by software and computerized systems doing them better. Agents that we hire for parts of our lives. And I think money is one of those areas where the evidence is overwhelming that when left to our own devices, we don't do it well. And so the idea of automating financial best practices in software and making it available to everyone, I think is a phenomenal innovation. I think the great thing is that now Moore's law is working in our advantage. And every year the software gets better and does more and more. So I'm a big fan, I guess I would say. I obviously have a bias, towards a particular company and a particular solution. But the truth is, if all you did is spend less than you make, right? Automate your savings, right? A certain amount you're saving per month, automate it. Make sure you have an emergency fund, and then make sure the remainder goes into a diversified portfolio of index funds for the long term. You are so far ahead of the average American. It's unbelievable. I mean, it sounds so simple, but most people don't do it. But the rewards for doing it are phenomenal. And automated advisors, whatever you want to call it, they just make it that much easier to automate all those decisions, right? You don't have to worry if something pays a dividend. You don't have to worry about how to rebalance your portfolio. If you're going to deposit $1,000, you don't have to think about what to invest it in, what's cheap, what's expensive, none of that, right? The automated software takes care of all that for you. And now services like Wealthfront are actually automating financial decision-making, right? How much do you have to save to buy a home in a particular area? How do you save for your kids' college? These are all things that can be done in software with fantastic data sets, privacy, and personalization. So I'm a big fan of them personally. I obviously use it myself. But I think anything you do to make better financial decisions and automate more of your behavior, even if you don't do it through a robo-advisor, if you do it through a traditional financial advisor, if you do it yourself, anything you do to automate your financial decisions will make them better decisions.
So this is a part two to that question. And in that case, if 3 standard deviations of the people, so 99.5% of people use robo-investors, who are the losers? To make a profit, someone has to lose.
Well, I'll say 2 things to that. One is it seems pretty far off from happening, right? I think we have a ways to go before we get there. I mean, honestly, you talk about this advice, a random walk down Wall Street is over 40 years old. And the percent of people who actually are investing in index funds still is relatively small as a percent of trading or as a percent of assets. Most people don't follow this advice. But the second thing I'd say is that actually it's not true that profit and loss requires winners and losers. It turns out that the economy actually grows over time. Businesses do get more productive. The economy is not a zero-sum game. We get better as humans at creating economic value in most years. And actually owning things like equities or lending money like bonds is a way to tap into that never-ending engine of humans getting better and better. And so as a result, it's actually not required that someone wins and someone loses. And there are very high-functioning markets. I'm not sure if you may or may not know the treasury market, for example. Most people in treasury auctions, and remember these auctions cover billions, tens of billions, hundreds of billions of dollars, actually just take the market rate. And a small number of people bid for 1 penny advantages on what they will pay or won't pay. And it turns out that price discovery of a small number of people actually creates a very efficient market for all the other people who are just happy to take the deal that shook out amongst the experts. And so for most of us who are retail investors, who are just looking for that return, that's fine. And yes, it actually turns out there will always be a very small number of active investors needed, and they will always find profit at squeezing that last penny out and getting a slightly better deal than the rest of us did. But in return for that better deal, the rest of us get the peace of mind and ease and low expense of not having to do that negotiation in the first place.
Awesome. Oh man, that's what are your thoughts on pensions, the 20 trillion debt, the finance of seldom used sports stadiums through bonds, and Social Security being around in 30 years?
Wow, I'm probably the wrong person to ask on a lot of these topics, not because I don't have an opinion. Everyone has an opinion. But you're going beyond my level of expertise. It's not really personal finance. At the high level, I would say I think pensions are probably closest to my wheelhouse. There are a lot of reasons why pensions have become unstable, particularly in the United States, but actually in general, it turns out the idea behind a pension is a very good idea. It says, look, if individuals are so bad at investing their own money, why don't we centralize that long-term saving with a pool of experts who can then use that size to invest in even better things that retail investors don't have access to, and then make sure that you're meeting those goals. And also we'll defray some of the risk, right? Good years, bad years, because we always have more people working and people who need to retire. Like I said, there's a lot of reasons why it turns out both politically and then in terms of agency problems of the people running the pensions, that the track record for pensions isn't great. On a global basis, and certainly in the US, we haven't been running that money effectively, and the gap that we have between what pensions have to pay out versus what they have and the assets to do it just seems to look worse and worse every year. But the problem is the pension problem is a real problem, right? How do you provide for long-term savings? I personally am not very bullish or excited. I like the revolution of having individual accounts and giving people more control over their money. But unfortunately, without professional advice or without assistance, it's led a lot of people to make very poor decisions with their 401ks and IRAs, right? You see people all the time taking that retirement money, not saving it, pulling it out, or putting it in poor choices. Actually, one of the reasons I'm so excited about software, to the earlier questions, I think it may offer a third way. What if we could replicate the advantages of pensions, but in individual accounts where you have personal control over it? I think that might be the best of both worlds. And so I'm hopeful that software may help solve part of this problem long term. On all the other questions, I don't know if I'm probably above my pay grade to answer. I'll just point out on sports stadiums, you're definitely asking the wrong guy because not a big sports guy. But I hear people like to go to those games, but the costs seem unbelievable. But anyway, like I said, not an expert in the area.
How would you define financial freedom, and how could we as engineers achieve it?
Now, I love this question because you're getting at the heart of why this problem is so tricky, because it's almost never actually about money, right? The goal isn't money. The goal is some life that you want. And it turns out in our economy, money is almost always the path to getting that life. And the real question is, what kind of life do you want? And I know everyone thinks they might have an answer, but if you think about it, you probably don't have an answer. It tends to be very tactical, very short term. And so I love this question of what financial freedom is. I've seen many definitions. There's many popular folks around. There's no question. One target that some financial planners use is having enough money to retire, not because you would then retire and play golf all day, although I'm sure there's some people who like to play golf all day. But actually this idea of having enough money that you can do whatever you want, work at any job you want to work, build skills in any way you want, and not feel financial stress is one goal. Unfortunately, it turns out there's no amount of money you can make that you can't spend, right? I mean, we all know famous stories of lottery winners who won hundreds of millions of dollars and are bankrupt, movie stars and musicians and sports athletes who made hundreds of millions of dollars and end up bankrupt a decade later. Our economy is very good at pulling money out of people if you let it. And so fundamentally, I think the important thing that people have to get down to is what kind of life they want to lead. How do they want to work? How does that balance out with their family? How does it balance out with what they do day to day? Some of the happiest people out there don't make a lot of money and live frugally. And that's not to say that there aren't some very wealthy people who lead happy lives as well. But I love what you're talking about. For me personally, financial freedom, I actually personally advocate it's people feeling like they're in control of their life. It turns out, I think most humans, we don't like uncertainty, and life is full of uncertainty, right? We don't know what the stock market's going to do. We don't know what the job market's going to do. We don't know which platform's going to win. I mean, there's so many things we don't know. And many of them don't impact our lives that much on a day-to-day basis, but some of them do. And more often than not, we're worried about how they do. And especially when you have loved ones involved, it gets even more stressful. So I think a lot of people, the process of financial planning, of having a plan, executing against that plan, if you're worried about sending your kids to college, having a plan and having done the math that this should work is almost half the battle, right? But anyway, I mean, that's how I tend to define freedom is that kind of security, emotional security. And the truth is people get it in different ways. Some people get it by paying off all their debt. Some people get it by getting their income to a certain level. Some people do it through very direct planning. But whatever your method is, I think it's an important process for everyone to be working towards that feeling of financial freedom.
Just to check in with you, Adam, how much time do you have before we should let you go?
I'm free for another 10 minutes. It's no problem.
10 minutes? Perfect. All right. What future do you see for cryptocurrency? Do you see any other interesting applications of blockchain technology?
Yeah, well, this is another one where I'm fairly biased for a couple of reasons. One is, the firm I'm at now, Greylock, of course, is invested in Coinbase and a number of other cryptocurrency firms. I personally have been excited about cryptocurrency for at least 5 or 6 years. And I mean, being a software engineer, it's hard not to be excited about cryptocurrency. Like when I started my career, this was an unsolved problem, right? How to have a decentralized source of truth, right, for kind of securing digital assets wasn't a solved problem, right? Like the 90s, the last decade, a number of the companies I was at actually tried to work on this problem and failed to come up with a solution that was decentralized. So it's hard to be a technologist and not be excited about blockchain because it really is an innovative solution. And history has shown the minute we come up with an innovative solution to a problem, we start finding other problems that we can use that solution for. And so I think it's a very exciting time. I'm often asked about cryptocurrency from a point of view of investment. I think that's a much harder problem because frankly, we don't have enough data, right? When you evaluate, one of the reasons you can have confidence investing in stocks and bonds and commodities and real estate, whether you like them or don't like them, we have huge amounts of data about how they behave. And in fact, a lot of the debates are between which data sets to use and which ones are relevant, but fundamentally we have a lot of data. Crypto is so new that there's a lot of guesswork involved, right? And even the most fervent advocate for crypto has to admit that like the last 5 years were pretty exceptional, right? And unlikely to repeat in the same dynamic. And so as a result, there's a lot of guessing there. And so from a prudent financial standpoint, it feels more speculative, right, in terms of guessing, than grounded in kind of empirical data. Now, that being said, I've probably been in the camp that you shouldn't put money into crypto that you cannot afford to lose. And I mean that literally. Right? When you put money in the stock market can go down. It can go down a lot. I mean, just in our lifetimes, we've seen the stock market go down at least 50% from its highs, right? That can happen. With crypto, it could be much larger. I mean, the dot-com boom, right? You saw a basket of internet stocks lose trillions in value, right? A lot of the internet stocks lost over 90% their value, even more. And I get very nervous when I see people putting money into crypto that they can't afford to lose. So my advice tends to be, in general, away from crypto financially, is that you should have the bulk of your investments and savings in a prudent, diversified index portfolio. And when I say the bulk, I mean 90%. If you want to keep 10% of your money to invest in speculative bets that we know rationally we shouldn't do, but we all want to believe that we have some insight that we can do it. If you want to buy an individual stock with that last 10%, you can. If you want to buy real estate with that last 10%, you can. If you want to buy crypto, you can. But like I said, I get nervous when I see people putting money into crypto that they can't afford to lose. It's too early. And the good news is if you're a big believer in crypto, even a very small percentage allocation in the upside scenario could turn out to be significant. So that's why diversification works, right? It's the idea of not putting so much into any one basket that if it goes wrong, you've ruined your entire financial life, right? But I am very excited about crypto, very excited about the technology and the applications. I think there's a possibility that 10 years from now, we will be talking about crypto as a viable asset class, or at least some people will be. I mean, already there are some people doing the math to try and justify it as that.
Fair enough. So currently we have a student whose majority of their emergency fund is stored as a small savings account, in a small return savings account. Is there a better way to store it?
Well, first, congratulations. Just having an emergency fund puts you ahead of most people, and I think that's fantastic that you have it. The key with an emergency fund, to my earlier talk, is that you want it to be liquid. You want to be able to have easy access to it if you need it. And so the place you also don't want any volatility risk. You don't want a risk that when the emergency happens, your money is worth less than it was before. And by the way, a lot of the reasons that you have an emergency turn out to be correlated, right? A lot of people lose their jobs or have trouble finding work exactly when stocks are down, right? Or bonds are down. And so in general, I recommend that people keep their emergency fund in an FDIC insured savings account. It sounds like that's what you have already. It turns out, most banks that you walk into, retail banks, pay almost nothing for this. That's not the end of the world. The point of this is not to actually make a return on your money. The point is actually to have it be liquid and safe. But of course, online banks are paying more. You can find online banks that pay up to 1.5% now. They're FDIC insured, very liquid, right? Link another bank account, you can push money over. That's a good option for an emergency fund. I know some people who use other vehicles through the Treasury, Series I savings bonds, et cetera. It's a little bit more complicated. They're not quite as liquid. In general, I think that if you get too spun up about making money off your emergency fund, you're starting to miss the point. Remember, if you don't use your emergency fund, honestly, it's good news. That means unlike 2/3 of Americans who every decade have an emergency, you haven't. And the likelihood that your financial trajectory will continue up and to the right is actually pretty high. So try not to focus too much on the return, but if you have to use an online savings account to get that 1.5% and that makes you feel better about it, that's a fantastic solution.
All right. So how do you feel about Dave Ramsey?
I've never met him.
Never met him.
I've listened to his show quite a bit. Like everyone out there, I think in general, I like smart, charismatic people talking about personal finance. He seems to have had a positive impact on a number of people. From a rational standpoint, his advice tends to be more emotionally driven, right, than rational. So, for example, the debt snowball isn't financially the ideal way to pay off a number of different debts, but it seems emotionally to feel good to people. So whether it's the debt snowball or actually paying off the highest cost loan first, in either case, getting people to pay off debt is probably a good thing. Actually, I probably in general like many of the things he says. I've heard sometimes I'm uncomfortable with some of the investment returns that he promises to people. I don't know that that's realistic or that the data supports those high rates of return. He probably leans more on real estate than the financial data would suggest you should. But overall, I'm fairly positive. And like I said, I haven't met him. I'd be happy to at some point. But I think for the most part, he's probably doing good by getting more people to think about their personal finance and taking control of their lives. So probably net, I'm positive.
All right. What are some medium risk type of investments? How would you describe that?
That's a very interesting question, and I like the intent behind it, because the intent is getting into understanding what risk is, right? So it's okay. I know that if I keep my money in cash, I probably won't even beat inflation, and so that's bad. But putting all my money in very risky things that could drop tomorrow by 10%, that doesn't feel right either. Is there something in between? So the short answer to that question is that yes, there are many things in between. In fact, there's a whole spectrum of investments. Even within different types of investment, there's a spectrum, right? In the stock market, right, the volatility of a stock like Tesla is very high, and there are stocks that have very low volatility, right? In the bond market, it turns out a bond that is lending money for 1 year is far less likely to move up and down than a loan that gets paid back in 30 years, right? So in every type of investment, there's a spectrum of risk. Now, that being said, within those type of investments, they're very correlated. And so there's two ways you get to protect yourself. And the best way to find a medium risk investment actually turns out to be different forms of diversification. It turns out to be balanced. When you own a little bit of every stock, you're not taking any of the risk. I shouldn't say any. You're not taking most of the risk of owning any one company because you own a little bit of everything. That's one way of taking a high risk, which is that an individual company will go bankrupt or lose a lot of money or drop 50%, and turning it into a risk that's more about where the economy is going and where companies are going and profits are going in general. So diversification, you can dial out different types of risk. You get rid of individual security risk, which is what I was just talking about, like the risk any one security will go bad. Like GM bonds might have trouble in one point in time, but bonds in general don't have the same problems that one company does. And then when you diversify across asset classes, you get this extra benefit because some go up when others go down. Or maybe it's just as simple as when some go down a lot, others go down a little. And then rebalancing helps you take advantage of those ups and downs. Now, I know that may not be the answer you were looking for, and that's because I think that the right way to get that risk reward where you want it to be isn't by picking a type of investment. It's by being diversified against all the different types of investment. And that's really, I think, the path that you want to go for.
All right. This is the last question.
Okay.
And it's got a bit of heft to it.
Okay.
Are 401ks necessary? And if so, Roth or traditional?
These are great questions. I've actually written posts about them if you want more detailed analysis. So the short answer I would say is that 401ks are not necessary, but for most people, they end up a much better way to save than the alternative. And the reason is because the nice thing about the 401k is that it automatically comes out of your paycheck, right? It's done through your paycheck. You never even see the money. It goes straight in there. And there's some friction around pulling it out. And you may say, well, I don't like that friction. I don't like the idea of fees. I don't like the idea that it's hard to get to my money. And that's very natural. And that would be true, except it turns out that every time humans touch money, we tend to make it worse. And so actually, the 401k has turned out to be a good vehicle for the people who have automated that savings and left it alone for long periods of time, right? And if you're at a company with a good 401k, and there are many companies with good 401ks, it can be a fantastic way to save. What do I mean by a good 401k? I mean it has very low fees, index funds, good selection of asset classes. Frankly, if it just has a Vanguard target date fund, you're winning. So I think that for most people, 401ks are good. Are they necessary, though, which was the question? I don't think they're necessary. I think there's some tax advantages to be able to put that much money away, right? Because with an individual retirement account, you can only put away about $5,500 a year. And if you're over 50, you can put $6,500. Whereas in a 401k, you could put up to $18,000 a year, and even more if you're over 50. So there are some advantages there. So I think the number one question to ask is, does your employer have a good 401k? I have worked for some employers where the 401k choices were so poor that it was probably counterproductive. You know, in a tax-efficient solution like an index fund portfolio like Wealthfront has, or other services, or just going to Vanguard directly, it can turn out your fees can be so high that the tax advantage isn't really worth it. But in general, I tend to recommend that people participate in their 401ks. Remember, as you move employers, you can always roll the 401k over into an IRA anywhere at your choosing. And so most people, especially in technology, don't work for the same company for long periods of time. In fact, the average employee works for a technology company, somewhere in the order of 2 to 4 years. And so even if you're trapped, you don't love the 401k, you're going to get out of it soon enough. And so that pattern of leaving your job and not stranding your 401k, not spending your 401k, but rolling it over into an IRA is a very good pattern. Now, the question about Roth IRA versus traditional is tricky because there's a number of different variables at play. For most young people who are high income, and I define high income as making 6 figures or more, there's definitely a thumb on the scale towards Roth for a number of reasons. Roth has some more flexibility on it, and the tax benefit of being able to contribute that much into a Roth account where you're never going to owe taxes again, and then having that money compound tax-free overcomes the fact that you don't get to deduct it this year. When you have a normal 401k, most people, when they look at their account balance, they don't realize it. But actually, your 401k is never quite as big as you think it is because accruing on it is a tax liability, right? You got a tax discount because the deduction you got when you contributed to the 401k. But as your 401k grows, that tax liability is still going to get paid eventually, although there's some ways to take care of it at the end. But net, the math tends to work out in the Roth favor if you're higher income. But there's a lot of detail around that. So I highly encourage the person who asked the question to read up some of the blog posts. I've written them on my personal blog. There's some blog posts on the Wealthfront blog that actually cover this topic and actually do the analysis and show you the numbers so you can make a more informed decision about whether it makes sense for you personally.
All right, Adam, I feel bad. I lied. There's one question that is kind of important.
Okay.
I skipped it by accident. Can we lower our emergency fund amount by buying insurance which spaces out the cost of emergencies, leaving more assets to use for investing?
Okay, it's a good question. That's not something I would recommend. And it's for 2 reasons. One is it turns out insurance products are actually very expensive. They may not sound expensive, but when you net out what they do for you, the risk they're taking, the fees that they charge implicitly, there's a reason why insurance is a very high profit industry. Very high profit. I mean, this is why every time you buy a dishwasher, insurance is the add-on sale that everyone wants to sell, because it turns out the average human is risk averse. And so we overpay for insurance. It's a great business, and there's a whole bunch of reasons why it makes sense. And I don't recommend against people getting certain types of insurance. Term life insurance is incredibly valuable. Obviously, health insurance is incredibly essential. You have no choice about getting car insurance, et cetera, et cetera. And so it's not that I'm against insurance, but in this case, I'm worried that you're optimizing the wrong problem. It turns out that if you have a pattern of spending less than you make, it may feel frustrating to build up that emergency fund, but having your emergencies taken care of and then having the freedom to invest for the long term will end up dominating that equation. Now, look, if you have the type of skills where you're confident that it wouldn't take you 3 months to get a job or 6 months to get a job. Some people recommend emergency funds up to 12 months. I think there's some judgment in there around the size of the emergency fund. I think there's also some judgment as you find more financial success about where you could access liquidity if you need it, which lowers the need for an emergency fund. But for most people, I tell them I would optimize around 3 months of expenses. And the best way to make that amount lower is to actually have lower expenses. And that's the path that will lead to the most financial success, at least from what I've seen and read.
So it boils down to profit more by spending less.
It turns out, I mean, like there's some things that you want to resist because they're just hard, right? Like we all want to resist that it'd be better for us if we just exercised more and ate less. Money is a little bit like that. Like everyone wants to resist the idea that actually if you just spend less, right? Actually, a lot of these financial problems get easier, but it turns out they do. And it's hard because it means giving up things that we love. And And we have a lot of foibles. I mean, we have this problem. We look around us and we see that one of our friends went on vacation. One of our friends has nice clothes. One of our friends has a great car. And we think, why don't I have a nice vacation? Why don't I have nice clothes? Why don't I have a nice car? None of your friends actually have all those things, but our brain wants us to like be the sum of all those things. And it's what keeps pushing us to spend money on things that frankly we can't afford. And in most cases, we don't actually need to be happy. I have no problem with people spending money and on the things they love and actually looking for more. But it turns out every time you spend more money, whether you borrow it or not, you actually put yourself at a little bit more financial risk, right? Those expenses really are the key. There really is something to that idea that you have this bigger nut to crack that you have to come up with every month, every week. The more you spend, right, the more you have to cover. And if you have a bad situation, an emergency, or you lose your income for a period of time, it's really your expenses that make the problem hard. It's not the size of your income. So in general, I mean, with emergency funds, et cetera, I encourage people to focus on their expenses. I encourage people to keeping the money safe. But even having $1,000 saved up makes a phenomenal difference in your ability to weather at least small storms. Won't help you if you lose your job, but even $1,000 will help you in situations where you avoid the worst thing that you could do for yourself, right? The worst thing you could do financially are things like have to hit your 401k or your kid's college savings fund. I mean, these are things that are not only financially painful, they're emotionally painful, and they leave scars. Having an emergency fund protects you from all those things, which is why I'm such a big advocate for it.
All right. Adam, I'm sorry for having gone 10 minutes over.
It's fine. I'm happy to do it. I'm glad that people are so interested.
But everyone, adamnash.blog and at Adam Nash on Twitter. This is Adam Nash. Your help has been invaluable. Thank you for your time.
Thanks for having me. See you later, everyone.
Bye, y'all.